Investors are concerned and fearful these days. With wars in Europe and the Middle East, tensions high between the US and China, and elections coming up in America and 10 other countries, there's a great deal of geopolitical uncertainty. And we think that fearfulness has kept many investors on the sidelines. But when it comes to the global economy, there is a different picture unfolding. We call it slow then grow, investing in the market's big reset. We forecast that the US economy is going to slow as we enter 2024 and improve as the year ends, leading us to a much better 2025. We do not expect a traditional US recession, nor do we expect a V-shaped recovery. Return forecasts are just that, forecasts. They fluctuate with changing conditions over time and are subject to change without notice. Though our analysis may be wrong and conditions may change, let's take a look at what our assessment of recent data suggests. Inflation appears to be coming down. Employment growth is slowing based on the latest data. Corporate profits are higher than many analysts expected. Wage growth, even in services, is moderating based upon Labor Department data. Most equity valuations appear reasonable as they're closer to their long-term averages. High short-term interest rates of today are unlikely to be available tomorrow. On average, the Fed has maintained its peak rates for only 7 months. The US and global economies have been more resilient than most expected. In short, a diversified portfolio of equities and bonds can offer investors potential benefits. What we call slow then grow is a period of economic normalization, followed by a period when markets may be able to see improving growth prospects across the US and then the world. There are many factors that may slow economic growth, so investors need to understand their risk and return objectives. As investors, we're mindful that past performance is no guarantee of future results. But at the moment, past performance, especially the dismal equity and bond markets returns of 2022, may actually present tactical opportunities. Economies grow most of the time. In 87% of all months since 1945, US data show economic expansion. This is why patient investors have been rewarded over long periods of time. Of course, no opportunity is guarantee of success, and forecasts can fluctuate with changing conditions over time. In addition to adding to or establishing core portfolios, there may be some shorter-term opportunistic investments for qualified investors to consider. Markets in transition often present timely entry points due to mispricings, a lack of investor interest, or even underestimation of outcomes. All three are at work these days. That said, we cannot be sure if these opportunities will be profitable. We think cybersecurity software firms may present opportunities given their critical role in protecting governments and firms from the dangers of cybercrime. We think Western energy companies may provide income and may generate diversification benefits if energy supplies are ever challenged. We think growth shares in the US, particularly small and medium-sized companies, are priced lower than their long-term averages and may present opportunity for qualified investors who understand equity risk. And we think the subject of artificial intelligence is more important to the future economy than the internet has been over the past decades. These are ideas we discuss in our 2024 outlook called Slow Then Grow. Today, the US has an economy that is growing faster than other Western economies. After the COVID pandemic has ended, and if the US economy continues to grow, other countries may experience their own growth. While there can be no assurance that the following outcomes will occur, it would not be surprising if Europe may regain some of its momentum in 2025. India and Mexico are potential beneficiaries of onshoring and maintaining more open economies. China may see a slow recovery if the impact of numerous policies to support growth and address their real estate crisis are implemented. Of course, there is no way to estimate what China may or may not do now or in the future. Though there are reasons to be fearful, this is information that suggests that the US economy may slow and then improve in 2024. How can a slowing growth rate be good news? Well, in our slow then grow assessment, a bit of slower growth may allow the Fed to end rate hikes. We do not know when or if this may happen. If the Fed's own estimates are correct, lower inflation will ultimately allow the Fed to stop hiking and then reduce rates. Again, whether or not this occurs is market dependent. If we're wrong and the economy slows faster than we forecast, the Fed may reduce rates even more quickly than we expect. In either case, companies may have the opportunity to grow if our views are right. Though we cannot know when to move from cash to being more fully invested, balanced portfolios of diversified investments have historically earned more than cash. It is precisely when one is uncertain and markets act poorly that one can re-enter and enjoy a reset. Thank you for listening, and please read more about Slow Then Grow, our outlook for investing in 2024 and beyond.